the strategy isn't to be a real estate guy or a stock market guy or a crypto guy or forex guy. The strategy, if you look at just the playbook, I didn't invent any of this, but the hedge funds and the sovereign funds, private equity groups, family offices, you look at their playbook, they have an allocation strategy, right? And so they're saying, I'll get this sliver here, sliver here, sliver here. But our thesis really is the Venn diagram of three things. It's what is recession resilient? I'm going to take my portfolio, I'm going to invest somewhere else. What is a recession resilient next piece that we can invest in? And then so that we're strategic. And then what is non-correlated? Now, that next piece, non-correlated means can't rise and fall together. I can't have my whole portfolio rising and falling on interest rates or on the stock market or on commodities. I got to have something that is up while the others are down. So non-correlated, we call that, which you find legal, medical, real estate, oil and gas. And then insulation from AI resilience is really a hyper focus for us now, because that is triggering the most uncertainty in the fundamentals of most investments out there. So where can we invest, which isn't immediately on the chopping block in the next 10 years for AI disruption or obsolescence?
If you're a real estate investor and are wondering how to raise and leverage private money to make more profit on every deal, then you're in the right place. On Raising Private Money, we'll speak with new and seasoned investors to dissect their deals and extract the best tips and strategies to help you get the money, because the money comes first. Now here's your host, Jay Conner.
What if your money could be working in assets that don't move with the market at all? Today's guest is about to stretch how you think about investing. I'm talking about litigation finance, medical receivables, and commercial opportunities most investors never even hear about, let alone profit from. Welcome to Raising Private Money. I'm Jay Conner, the Private Money Authority. And if you're serious about finding new, smarter ways to fund your deals and grow your wealth, you're in the right place. My guest today, Patrick Grimes, is a serial entrepreneur, CEO of Passive Investing Mastery, and a specialist in alternative investments that are designed to produce both growth and cash flow without being tied to traditional markets. He's built a diversified portfolio across everything from energy to lending to thousands of apartment units. And today, he's breaking down how everyday investors can access recession-aware opportunities that most people don't even know exist. So put your seatbelt on, because this conversation might completely change how you think about where your money comes from and where it should be going. In just a moment, you're going to meet Patrick Grimes right after this. Patrick, welcome to the show.
Glad to be here. Looking forward to the chat. Appreciate the nice intro.
Absolutely. Well, Patrick, let's go ahead and dive in. Most investors have never heard of this thing that you talk about called litigation finance. So what is it really, and why has it quietly become such a powerful asset class?
Well, it's another private credit strategy. Similar. I mean, people probably understand real estate more. So if you're lending to a real estate operator so they can buy and improve a property, you're really just lending against an asset, and you're doing a finance amount for a collateral value. Well, it turns out you can do that in any industry, like legal or like medical, where there's operators, maybe they're attorneys or maybe they're doctors, and they have assets and they have a value, and you can finance that with a conservative finance rate against that collateral value and put a lien, just like you do on a property, and put a lien, a UCC1, on a law firm and their assets as well as a medical practice. And so it's just the process of using the similar private credit skills and knowledge, but across different industries. And the reason why they're compelling is because they don't rise and fall together. Real estate doesn't ride the same underlying fundamentals that the legal industry does or that medical does. And that's why I think they're compelling.
That is very interesting. Take us back, Patrick. What was the moment where you realized this is where smart money is going and decided to go all in on these alternative investments?
So I mean, it depends on how far back you want to go, because like many of your listeners, I was just a hardworking professional out there. I got a master's in engineering and an MBA, and I was a machine design, automation, robotics engineer. And I remember when I first started doing well at the first machine design firm I worked for, I asked one of the founders, had a lot of respect for this guy. I asked him, "Hey, where are you investing?" And I thought he was going to say, "Oh, this startup and that startup," because we were early on doing work for like Waymo 20 years ago for Intuitive Surgical, the surgical robots, Facebook, Google, Lockheed, Boeing, heart valves for Johnson & Johnson, all these really cool companies. I thought he was going to say, "Hey, here's the stocks and startups." But he said, "No, my only regret was not putting more into real estate earlier." So it's interesting that this tech titan had leaned me in towards the alternative space, and that's actually what really drove me initially.
So, regarding the value and the service that you provide, do you work with investors and show them and teach them and educate them on really how to use these alternative investments?
Well, I'm not a licensed financial advisor, attorney, or a CPA, so I can't give finance, legal, or tax advice, first of all. But I throughout my life as a professional engineer and an investor, I've had some wins and I've had some losses, and I've learned through ups and downs of markets that you can't be all in one asset class to have true financial security. You can have financial independence by being a real estate guy until the next cycle, right? And so I lean more towards the allocation strategies. And I myself was trading the baseball cards of different lesser known alternatives strategies with just a few guys for a long time. Nobody really knew. I didn't know where to access them. I didn't even know what they were, both asset classes, industries, or tax strategies, asset planning, all that stuff. So I built a platform, Passive Investing Mastery, specifically just because, man, I wish when I was an engineer, I knew more than just the 50 startups and the 50 stocks. I wish I knew about timberland investing in places, buying a plane for cash flow, bourbon barrel cask, legal, medical, investing in CPA firms and laundromats. I wish I knew about all these different kinds of things that have completely different non-correlated returns so I could build true security. So I built a platform for that to educate on all those. And we also have an equity firm that sponsors deals. And as you mentioned, commercial real estate, the medical industry, and the legal industry to try and actually be part of the solution.
In case one of our listeners has to jump off early, can we go ahead and give out the URL or the website to your platform so they can learn about that?
Yeah, it's passiveinvestingmastery.com, all spelled out, passiveinvestingmastery.com. A little bit long. And on that site, you can register for our Alternative Investing Mastery series. We've now had 60 different sessions. They're bi-weekly sessions where we bring on panels and we dig into all different kinds of asset classes, from metals and minerals to Forex to everything, every kind of real estate you can imagine, so that you can get exposed to these alternatives. And on that site, we also have different opportunities to invest into alternatives. We also give away a book, which at the end, I'll probably, if you allow it, I'll give them the URL for that.
Oh, wonderful. Well, thank you for going ahead and sharing that URL. I don't want anybody to miss out. Why is it that you believe, I think I know one or two of your answers, but I'm going to ask you anyway for the sake of the audience. Why do you believe traditional portfolios such as stocks and bonds and maybe even real estate leave investors more exposed than they realize, in contrast to these other non-traditional assets?
Well, it's interesting. So most of the most popular investment strategies out there are fairly volatile. They undergo large market swings over decades or 1 to 2 decades pretty regularly. And if you zoom out, you're going to see the stock market go like this. You're going to see technology. You're going to see real estate go on these 1 to 2 decade cycles. You're going to see oil and gas go on very volatile, which is fairly popular. And so the strategy isn't to be a real estate guy or a stock market guy or a crypto guy or Forex guy. The strategy, if you look at just the playbook, I didn't invent any of this, but the hedge funds and the sovereign funds, private equity groups, family offices, you look at their playbook, they have an allocation strategy, right? And so they're saying, I'll get this sliver here, sliver here, sliver here. But our thesis really is the Venn diagram of three things. It's what is recession resilient? I'm going to take my portfolio, I'm going to invest somewhere else. What is a recession resilient next piece that we can invest in? And then so that we're strategic. And then what is non-correlated? Now, that next piece, non-correlated means can't rise and fall together. I can't have my whole portfolio rising and falling on interest rates or on the stock market or on commodities. I got to have something that is up while the others are down. So non-correlated, we call that, which you find legal, medical, real estate, oil and gas. And then insulation from AI resilience is really a hyper focus for us now, because that is triggering the most uncertainty in the fundamentals of most investments out there. So where can we invest, which isn't immediately on the chopping block in the next 10 years for AI disruption or obsolescence?
Yes, the phrase you talk a lot about is non-correlation, and I just found that very interesting, and you just brought that up. So, can you give a real world example of how that actually protects an investor when markets are going opposite directions? Or maybe a different question to that would be, can you give an example of when one asset class was going down, but if you're invested in non-correlated assets, maybe simultaneously another asset class was going up?
Yeah, it's well, if you look at kind of the US dollar over time conceptually, you've seen the value of the dollar go up and down, and you've seen gold follow a very inverse correlation. So while gold is up, the US dollar's down. Why? Because it's a safe haven asset. People invest in gold. Same thing with inflation. When inflation's up, people are seeking those gold. So that's probably the easiest example of a non-correlation. That's why metals or cash equivalent, we don't leave everything in cash, is really important for me. And we talk about that a lot on our platform. But real estate itself and the stock market tend to not ride in the same trends over time. It just so happens that there are industries that are kind of the better of both worlds, not only not riding on the same market fundamentals, but have stability on their own footing. And those are the legal and medical industry. Actually, if you look at any of our slide decks, you're going to see oil and gas, gold, S&P, real estate, all these industries go for a wild ride, and legal services and medical services just straight up into the right. It's pretty incredible, some of the fundamentals, how stable a lot of these industries are. If you look at one like CPA firms, well, CPA firms also, it's like betting with the house. Your house always wins. Good times, bad times. CPA firms always tend to do well. However, that third Venn diagram, resilience from AI obsolescence, that right there is 100% likely to be dramatically impacted. So investing into CPA firms is something that might fundamentally have the majority of the labor taken out, and that may be swooped up much more economically into larger institutions. So I don't think CPA firms, although they have non-correlation and resilience, I don't think they're the best investment right now. Dueling with some friends that are actually rolling up CPA firms right now. But that's some examples for you. A really interesting one, gold and oil and gas. Gold and oil and gas, like how could they be connected? And if you actually look at the trends, gold and oil and gas 80% of the time have correlated, have risen and fallen together. And they're both safe havens. People tend to flock to both of them in times of market uncertainty, even though they tend to be, especially oil and gas tends to be somewhat volatile. But the fundamentals, the market fundamentals behind what drives those are in mostly the BRICS nations. And the impact on the BRICS nations tends to drive, there's data suggests that they tend to drive them together. So some things will rise and fall together unknowingly. And so I think the study of what is the market fundamentals of each of your investments, what is the market cycles. And we didn't talk about my story, but I lost everything in 2009 and 10 in my first real estate deal because of the market collapse. And then when interest rates skyrocket, I took a large blow in my allocation into apartment buildings because I was exposed to interest rate impact. Simultaneously, you have time when oil and gas is high, right? Because of some of the geopolitical environment, and interest rates are high. So, and when interest rates are high, we have a private credit debt fund. That means I'm winning from high interest rates. Right? And so you can actually make returns where if you're an owner, you're going to lose value, right? And then on the legal and medical side, feeling pretty comfortable. Why? Because they don't care. They don't care what else is going on in the broader markets. They're just doing their services. And as long as you're investing into an organization that's not going to get chopped away by AI, mostly we're an injury-based care and legal financing where attorneys are out there. We're going after sexual assault cases or water contamination at Camp Lejeune, that kind of stuff. That stuff's not going to go away with AI. As long as you're in those kind of industries, you can really build what I call financial security, not this financial freedom or financial independence, but more of a bedrock of financial security on top of your allocations in stocks and bonds and cash and and all the other stuff. Yeah.
Well, there's all these different multiple sectors that you have invested in. And my question is, let's say someone came to you today and just asked the question. I know you're not giving financial advice. Just ask the question. They said, Patrick, I got $1 million in cash sitting over here. If that $1 million was yours and you weren't investing in anything yet, how would you allocate that today and why?
Well, so I'm a little bit different animal because I'm a business owner. Business owners I run 3 operating businesses right now. And they have a little bit different matrix than most of the working professionals out there that are the JOB different plan. And it has a lot to do with your age, where you're at in the growth versus a more conservative cash flow or a conversion point, and whether it's a tax efficient account that you have it in or not. So, I mean, I've written articles in Forbes about all these different things. And the first thing is fundamentally is we educate on not just how to invest, but how to do it securely through asset protected structures. And somebody who's lost it all before, that's something I've written articles on, books, our chapters in books and articles in Forbes on. So I talk first about asset protection, starting out with a safe foundation so you can grow it securely. And then we talk about tax efficiency, starting out with the right kind of account. Does it make sense? Like where is it at now? How do we get it into something that it can grow tax efficiently over time, depending upon where you're at in your journey? And then we talk about allocation strategies. And if you look at all of our decks, we kind of show actually allocation strategies have been published by some Edward Wolf on the middle class, high income, and the ultra wealthy. We show some by Tiger 21s and how people kind of segregate their cash equivalents versus stock bonds versus their alternatives. And what you find is that as you get more astute, people tend to have half and call it the traditional investments and half in alternatives. And then really 25% of that pie, that half is in real estate. And that's why it is a very important foundational investment. Now, it depends on what kind of real estate, because there's a lot of losers right now, and there's some really good winners in our acquisitions fund. But then there's another 25%. Where does that go? It's not in traditionals. It's not in real estate. Where's that? Well, that's what we talk about is what kind of higher yield can you get at lower risk for non-correlated resilience? And that's depends on where you're at and what you're doing. But I actually have my favorites. If you go to investwithpatrick.com, that's one of the most common question I get is, okay, Patrick, you've hosted 80 some different alternatives on your platform now. What are your favorite ones? Investwithpatrick.com says, I don't have all these investments, but I list them all, my top 10. And then on the first page, and the rest of the PDF is my deep dive into them. So you can choose your own journey, choose your own poison, whatever it is. But we have these conversations, right? My goal really is not to be a guru and tell everybody, go buy mobile home parks. I don't like those anymore, right? Or buy any. I don't want to be a widget guy. I just want to blue ocean approach it. Here's every way you can invest outside of the stock market. All the different options you can choose. Bring panels of people that have been doing it 10, 20 years, 3 to 4 of them, and deep dive into all of them, and the asset protection strategies, the estate planning strategies, and really creative tax retirement account strategies. And have people gain that awareness and choose their own journey in life, but gain the awareness that it's out there so they can build that comfort and familiarity with them to be able to make some choices.
You mentioned a couple of minutes ago that you have an acquisition fund. Tell us a little bit about that.
Well, so when when you saw interest rates start to rise, and you're in this post, sort of the latter inside of COVID here, and when interest rates rise, you can choose when everybody's scared, right? You can choose to hide, or you can choose to make some strategic bets on the table and win from a high interest rate environment. So, us as a company, Passive Investing Mastery, myself, I partnered with two different friends of mine. One had been running debt funds. He actually co-founded Verivest and and exited a business that went from 0 to 3 billion in administration. That ran over 100 debt funds. And so I said, look, man, you exited. This is the best time to do debt. Debt all of a sudden is cool again because we are not, out on the streets lending at 6, 7, 8%. We're lending at 12, 13, 14% on the same assets on existing value in commercial real estate, not this after repaired value or completed value in residential, which is make-believe value. This is real value. This is really cool equity-like returns in real estate. So let's go out on the streets and lend at high interest rates in a high interest rate environment. And so lend at high, but then we started realizing there's a lot of opportunities to buy. And so then we realized, well, you know what? In this downturn, we need to be lending high at rates, and we need to be buying at low prices. So the acquisitions fund is the sister fund, which says, look, there's a bunch of distress. There's a bunch of blood on the streets, a bunch of people that just need or want out. There's trillions of dollars of commercial real estate debt coming due. And this is a really cool buying opportunity. And so we were able to pick up assets. Now, it's interesting because I had been in thousands of apartment units, and they had gone for a pretty dramatic ride. And that's really unfortunate. It sucks for a lot of people, and me too. I'm feeling the pain. But they're on sale during this time. But it turns out that when we underwrote commercial real estate, even today, apartment buildings still haven't recovered. They're still not to the point where they're a better buy than retail, industrial, manufacturing, warehousing. Those things are like, industrial is like 98% occupied right now. Resurgence on manufacturing is huge. So we found ourselves in an acquisitions fund doing none of what we used to do, only doing industrial, commercial, warehousing, and retail, and killing it because it's just such an incredible asset. So that pivot, right, and that opportunity to win from the upside at lending at high rates and buying at low prices is really a great value, is really what led to those two funds and their timing.
So am I assuming correctly, the acquisition fund that you have is something an individual could invest in if they didn't want to go decide between 80 different sectors to invest in?
Yeah, so the acquisitions fund, theoretically, we've had it fully capitalized now for about 6 months a year. We have a pretty substantial wait list for that because it's been doing quite well. Somebody could certainly go and join a wait list for the acquisitions fund. The debt fund is certainly available. It's an income fund, currently cash paying income fund. It's doing really well. That's also something people can invest in. And then the legal and the medical side are both open as well.
Okay, so you have other funds that are open right now.
Yeah.
4. All right, awesome. When somebody is looking at, a syndication or an alternative deal or any of these sectors, what are maybe some of the top 2 or 3 factors or things that someone should, immediately be looking for before they, consider investing in one sector or another? How should they think about it, I guess, is my question. What advice, I know you can give this advice, what advice would you give them on how to make a decision on what they want to invest in?
So what they want to invest in, or the due diligence on a specific investment. Sorry, you started one way and I got the on the back end.
Yeah, in other words, what's the decision-making criteria on whether I want to be in A sector, B sector, C sector, or
Yeah.
what I want to be? No, in other words, not the due diligence on a particular opportunity, but yeah, that sector.
Yeah, and I think it goes back to the allocations pie charts that we talked about before, where it has to do with the capital you have, where your investments are now, and then where you're at in life. And that's kind of specific to everybody, and it's really personal. And then there's this aspect of their risk tolerance, because there are people early on making, conservative bets, and people later on making risky bets. And I don't really know, and I don't really give the advice. But and then it does have something to do with how asset protected you are and how tax efficient, right, you can be. And so I like to have a conversation with individuals, because I don't give advice, but I have been around the block for a while, and I have seen ups and downs, and I've felt the pain. And if anybody wants to have a chat, I'd be happy to chat. And on my website, you can schedule a meeting with me. I leave our blocks open every week. It's one of the things that I love to do, is still invest. Now, I don't do engineering for many years now, and still get out there and talk to investors and help get them pointed in the right direction. We've ran across, I think we did 60 different alternative sessions. Then we hosted a summit. It was a 3-day virtual summit. We had 30 different speakers highlighting another 20 sessions. We had 600 people attend live for that event. Really, really cool attendance, actual attendance. And those are the kind of things you can do if you really want to get in there and learn or set up a call. But it's just, sorry, I'm giving you the non-answer here, but it really is so specific, right? And I have my favorites, and I tend to just like to chat with people one-on-one.
Okay. So if someone wants to talk about, well, what should I be investing in? Schedule a one-on-one call with Patrick, right?
Yeah, we'll help you get pointed in the right direction.
That's great. I know nobody has a crystal ball, but I do know the person that has more experience sits closer to the crystal ball, and that would be you, Patrick. Fast forward from now over, say, the next 5 years, what kind of shifts do you see coming in the investment world around the corner?
My biggest so 5-year horizon, you said 5 to 10-year horizon, maybe. My biggest concern really is AI disruption and people walking in a little bit blind. I still see all through COVID, like we stopped doing apartment buildings when we saw the fundamentals of the expenses and rents, the overbuilding, and we still took some hits during that as a result, but we stopped doing apartment buildings. There's people still doing buildings through kind of like taking a blind eye, even when things didn't underwrite like they used to, they didn't pencil. I still see people right now moving full force into industries which can be fairly easily destabilized by AI disruption. And we can see it happening in real time. And so I tend to ask people, hey, what within the asset class, who are you serving? What need are you solving within an industry? And I tend to be a spear fisherman here in Honolulu. I enjoy the sport. I do it a little bit less since my 3-year-old's back there. I have a couple of sharks that swim nearby. But anyways, I tend to like to use the analogy that you really need to just hold your breath and take a minute and be very strategic about what you go after, and you want to make sure you don't end up in some dangerous waters in the meantime, overexposed. And you need to study and learn and then strategically shoot, because right now my biggest concern is that that within the industries that you're solving a need for, can that need be relatively either functionally obsolescent, go obsolescent, or be automated through AI? And I see a lot of that happening right now. And then so I'd say both, what need are you solving, and then also look at the underlying service that's being provided, like if it's a housing community, or even if it's an elective medical surgery, or if it's investing in law firms that do certain kinds of contract work that could be automated versus representation for injury care. That is what we're doing. Take a really hard look at, is that market still going to be there? Because it may be that it's automated, or it may be the market disappears. For example, there's buildings next to large financial institutions in areas that are basically only populated by a series of large financial institutions as well as their providers, right? That submarket. But the finance industry is one of the first ones that's on the chopping block, and the big financial institutions have already stopped hiring. They've indicated they're going to start retracting or replace all new people with AI, and so you're investing in what should be a fundamentally good asset class in a good market with growth, but the one you're in, the customer base is on the chopping block, right? Or that, maybe the medical practice or even the law firm or whatever it is that they're doing, really take a hard look at that. And that's, I feel like I'm on my soapbox, kind of repeating myself here. But that's one of the things that as an engineer, when I look at the safety factors associated and I look at the underlying fundamentals, what are the biggest risks? And from somebody who's lost big before, I just don't want to do it again. I just don't want to do that again. And I didn't see it coming. I didn't look out far enough. And now I want to be able to do my best at trying to find that crystal ball, which is somewhere nearby. You're telling me, if you could point at it, that would be helpful.
Well, speaking of AI, as recent as this morning, I received an email from this company that was thanking me for my order that I had placed. I never heard of the company before in my life, and I certainly hadn't made a purchase. So I send a email to this company saying, I don't know what you're talking about. I don't know who you are. I don't know what this product is that you say I've bought. Well, in less than a minute, I get an email response from AI about my question. And that goes back and forth 2 or 3 times. Well, we had it resolved within about 5 minutes that I had ordered from them in 2020 and 2021. And please ignore their automated generated emails that are not current.
Wow. Oh, man, that's a funny one.
That was all through AI. Patrick, you mentioned that you have a book that you wanted to offer to my listeners. Please tell them about that, what it is and where they can go get it.
Yeah, so actually it's a book I did with some other guys. It's really fun, guys and gals. Lessons from Thought Leaders is the title. And I mean, I'm here, the engineering nerd, but then there's an actual Navy SEAL here, and there Brian Tracy, Phil Collins, the lead guitarist of Def Leppard, an actual rock star, Kevin Eastman, Ziegler, Dennis Waitley, some really cool people. It was a lot of fun to collaborate on this book. It did make a bestseller status. And I tell my whole story from, snot-nosed engineer losing it all in real estate and the subprime mortgage collapse, and then my journey through to single family and apartments and energy and legal, medical, income, private credit, and all that stuff, and why I founded Passive Investing Mastery to kind of give back in that blue ocean approach at getting alts out there. If this helps people along their journey, then it's enough of a thank you to me. And so if you go to passiveinvestingmastery.com/book, passiveinvestingmastery.com/book. Now, the key is you have to put the name of this podcast in the promo code, because we don't just ship it out randomly, but you can choose on that form to either download the ebook or get a hard signed copy sent to you. And, along the way, if that helps to contribute to your journey, let me know. I'd appreciate it. And I'd love to have a chat with you at one point or another.
So the code is Raising Private Money. Because that's the name of this podcast. Patrick, thank you so much. Wow, what a wealth of knowledge that you have shared. I can't thank you enough for joining me on the show. Thank you.
Really glad to be here. Great chat.
Excellent. Listen, if this episode got you thinking differently about where your money can work, then don't keep it to yourself. Because here's the truth. Most investors are still stuck playing in the same sandbox, chasing the same deals, getting the same results. But you're learning how to think bigger, differently, how to diversify smarter, and how to put your money and your opportunities in places where people never even look or never even heard about it. So do me a favor. Share this episode with one person in your network, one investor, one private lender, one friend who needs to hear this. And if you haven't done it yet, make sure you're subscribed to Raising Private Money so you don't miss the next strategy, the next insight, the next opportunity that could completely change your personal life and your business. I'm Jay Conner, the Private Money Authority, and I'll see you right here on the next episode of Raising Private Money.
Are you feeling inspired by the knowledge you gained in this episode? Then head over to jconnor.com/money guide. That's JCONNER.com/money guide and download your free guide that shares 7 reasons why private money will skyrocket your real estate investing business right now. Again, that's jconnor.com/money guide to get your free guide. We'll see you next time on Raising Private Money with Jay Connor.